The macro environment is absolutely key in driving stock prices, and this episode is dedicated towards that topic. I want to elaborate on the fundamental change in the structure of the financial markets and the impact on stock prices and other risk asset prices. This is the Not Even Wrong podcast. It's July 10th, 2020. This is Krim Delko. Before I go into the topic of today's episode, I want to give an update. We are up 16% today. We are up 137% for the year. The market today was up 1% and is down 1% for the year. So we're outperforming by 137%. The main contributor today was Tesla. And we also made money on our calls on RTX and Intel. We lost money on the CRISPR index. Now let's go right into the topic of today. Our our main contributor for the year has been Tesla, and Tesla is a very good example of a stock that is driven to some extent by its fundamental performance, but in our view, fundamentally driven by the change in the structure of the financial markets. What's happening is that we have zero interest rates in the US. According to the TIPS, the Treasury Inflation Protected Securities TIPS, these are bonds that are inflation protected. The 30-year tip has a yield of minus 25%, minus 25 basis points, I'm sorry. So that means that we're already in negative territory. The nominal interest rates in the US are almost zero. Even the 30-year in this week came down by almost 20 basis points. So it yields now 1.25%. So we are in unprecedented territory as far as US interest rates are concerned. And what that does is a couple of things. One is it puts in question the opportunity cost of money. It says, well, I mean, if I have zero interest rates across the board, well, what's money worth? I mean, how should I even think about what capital returns I should expect in the markets? It's a little bit like taking away gravity. Like you have to find a different way to navigate in a space without gravity. The interest rates, the treasury interest rate, the nominal and the real interest rate, has been the focal point of financial markets for decades. You start with the interest rates and you build models based on that. Now, if that is zero, just by sheer mathematics, if R is in a formula and it's zero, well, then the whole formula falls apart. And for anybody who's done any kind of finance, mathematical finance, computational finance, the R comes up a lot. The R comes up in many different ways. And whenever it's multiplied with something, which is mostly the case, or even worse, it's divided, it's a divisor, well, then, you're going to have a problem with your model. And I think that is the fundamental situation right now in the markets. That is that valuations across the board are not worth anymore, are not valid anymore, in a sense that you cannot use valuation models of the past and apply them to today's situation, because the interest rate is zero. So you have to come up with something new. And this is what's going on right now in the markets, is that the market is in search for a new way to valuing risk assets. And what's happening is, in many cases, nothing is happening. So companies or assets that are considered not interesting, or that have issues, that have fundamental issues, the market is saying, well, look, I don't know what's going on anyway. The valuation metrics are not worth anything, so I might as well not touch anything. This is partly the reason why the S&P is flat for the year, because, well, we don't really know what to do with the aggregate market. Then we have stocks like Tesla, Square, Microsoft, Apple, Google, Zoom. those are growth stocks. Growth is becoming incredibly scarce, and hence is getting a much higher premium than before. I predict that we will have valuations in growth stocks, even stocks like Microsoft, which are already at market caps of 1.5 trillion, that are growing double-digit type earnings. Those kinds of stocks will get to, we will see PEs of 40, 50 easily, simply because in a world with interest rates, we had 25, 30 PEs, and that was considered expensive. I predict that we can easily see a doubling of those PEs because of zero interest rates. And then we have stocks like Tesla, which forget PE. Tesla is a hypergrowth stock, not just because they are expected to grow, but also because there's a lot of optionality in the company. And there is things like AI, which have an enormous amount of disruptive power, which could be driving the company and the stock. So stocks like that, in my opinion, will get a dramatic overvaluation relative to the valuation models that we used in the past. And to some extent, that is very rational. The market is trying to find a new structure, a new way to value things. And one of the things that the market is valuing first is hypergrowth, because that's the most attractive destination for money right now. Other things will come, like, for example, real estate needs to be reevaluated. Right now, housing in San Francisco, I would think, is probably down slightly. Housing in New York is down because there are fundamental issues. Housing in countries like Lebanon or Chile, Switzerland is flat to down. I would expect over time that the prices will go up too, because like when you have zero interest rates across the world, not just in the US, by the way, in Europe and Japan also, but I think the US market is key because the US market was the driving force for pricing of assets across the world, not just in the US. So once we have zero interest rates here, which we have right now in real terms and almost in nominal terms across the board, like I said, once we're at that stage, we really don't have, we have to reevaluate our valuation models. Now, I don't have a good idea of how to do that. I'm not a theoretical financial economist, so I don't spend too much time in thinking how to, but it's an interesting PhD subject for somebody to think about this. And I'm sure an army of PhDs will think about this. But for us right now, practicing in the markets, investing money, I think the conclusion is that we have the valuation models of the past are not valid anymore. We will have to reevaluate the valuation models. We will have to give much higher valuations to growth, particularly real economic growth, which is companies that are disruptive, that are offering real value, which I define as 10x better and 10x cheaper, more or less, and some are more, some are less. But overall, companies which do something which gives the customers something much better for less money. And I would say that some of the Silicon Valley elite, like the Teslas, the Apples, the Microsofts of this world, they are in that category. Companies like Square, real disruptors of spaces like finance, banking, payments, PayPal, real disruptor. Companies like Lululemon, changing culture, growth, not because they're raising prices, but because more and more people want to change the way they dress. Companies like Boston Beer, offering new innovative ways to consume beverages in a way that hasn't been done before, and enjoying massive real organic growth, not just raising prices, changing packaging and things like that, but real organic growth. So the disruption goes across the board. It's not just tech, but I'm just saying these kinds of growth stocks will get much higher valuations because the valuation models have to be recalibrated, revalidated. And that is an impact that I think it's just starting. We will see much higher growth in the prices of these assets. I think as a consequence, as a second derivative of this, we will also see more volatility. I think there will be a point when these assets get stretched to points where, let's say, just an example, Microsoft will get to 60 times PE, and then people will get scared, and then there will be a correction. But then over time, there will come, money will flow back and say, well, no, I mean, I'm okay. I mean, yeah, maybe it should not be 60, maybe 50. And then it goes, let's say it corrects from the stock goes to 320, and then it goes down back down to 220, but then it sells somewhere in 280. So we'll have this type of volatility just because there is uncertainty in the valuation models. And so we expect more volatility. Same with Tesla. Tesla can go to 1800, 2000, and then correct back down to 1200 and maybe settle around 1500 over the next 6 months. This is a very likely scenario, not because the company is doing crazy things or the market is stupid or anything like that. It's simply because the market is in a fog of financial visibility from a valuation perspective, and it's just tapping itself towards some sort of new valuation metric with zero interest rates. This is not the mistake of stock investors, of analysts on Wall Street, or retail investors, or whatever you want to call it. This is just simply the Fed has created a new world of financial markets with zero interest rates, and all the participants have to recalibrate their models. And this is a fundamental shift that has happened in the first quarter of this year, around March, because of the health crisis. And we're going to see and feel this for the next couple of months, maybe even quarters. We will settle somewhere. There will be some sort of equilibrium in the short term where we will figure out, okay, you know what? Stock like Microsoft growing 15-20% earnings should be valued maybe at 60 times PE, given that interest rates are zero. Hyper growth stock like Tesla with lots of real optionality should be trading 12 to 15 times expected sales instead of maybe 6 to 8 times like it was in the past. Stocks like Square can trade 20 times sales. I know these numbers sound very extended right now, but again, we have zero interest rates. So the gravity of the financial market has been sucked out by the Fed. So we have to find new models to think about what assets are worth. And if the opportunity cost of money is zero, well, then you're going to pay more for growth. You're going to be enticed to take more risk. To summarize, the next couple of quarters, the markets will have to spend finding ways for new valuation models. This is the key. We have to know what things are worth. We need valuation models, but we can't use the old ones because the interest rates are zero, and therefore the models have to work with zero opportunity cost of capital. There's a way to do it. We're confident that the markets will find models to work with. They always do. The next couple of quarters will be interesting from that perspective, and we'll pay attention to that topic, I think, because it's key for the success in the coming quarters in financial markets. Thanks.